What stocks to buy in 2020? That is the question on everybody's head at the moment. So if we look at markets in the last couple of months, they've taken a sharp decline because of everything with the coronavirus. Over in the US, the S&P 500 was trading at about 3,300, took a massive decline and now has rebounded up to around 2,700. In the UK then, with the FTSE 100, it was up around 7,400, 7,500 for the peak in 2020, declined sharply and has now recovered some ground as well. So if we look at the US and the UK, the economies are both still in shutdown, yet their financial markets have rebounded substantially. And why is that then? If the economies are still locked down, there's no growth in the economy and they can't go out and do any trading or do any sales. Well, the reason is the central banks in both these economies have printed lots of money. So investors there have cash and they're out in the hunt for yield, looking at different stocks to buy and inflating the prices of these stocks. It's hard to know when the whole coronavirus will end, but there are some promising signs coming from China. The economy reopening there, different people going back into the shops and being able to go into restaurants as well, albeit they do have different social distancing measures and have to wear face masks as well. If you look in Europe, then you have parts of Spain and parts of Italy that are going back to work in the construction and manufacturing sectors, and definitely is a promising sign. It'll be interesting to see when the US and the UK can get back and working and integrating some people into society. So if we do look at different crashes that have happened in the past, it's always good to invest in the most beat down stocks. If they do rebound, then there'll be phenomenal growth in them and great returns for investors. So if we look back at the 2008 crisis, we saw that banks took an absolute hammering there. If you were invested in companies like Goldman Sachs or JP Morgan, some of the best and biggest investment banks, you would have made a great return in the last 12 years. It's always good to get in when the market has declined that much, because the growth can be phenomenal in the next few years. So looking at the two sectors then that have suffered the most since the coronavirus has been retail and airlines. So if we look at retail, it was really suffering a lot with the move to e-commerce and the likes of Amazon coming in and really having an impact on different brick and mortar stores. With airlines then, they've suffered because no flights have been in the air. Lots of their profits that would have been from customers going and taking flights to different destinations have completely dried up. If we're looking at retail then, we can really see the impact that the coronavirus has had on the sector. The likes of Debenhams going into liquidation in the UK really shows that it's going to be a difficult time for retail companies once this all blows over. So with airlines then, it only seems like it's temporary for them, because people will get back into the air. They will fly again, they'll go to different destinations. Whereas it's a change in dynamic for the retail sector, with everything going online and consumers being able to shop online instead now is a much more attractive prospect than going in and buying the stuff in the store. So with airlines, what you want to do is you want to look at beaten down stocks here and see who will be in the best position to come out of all of this with no debt taken on and not getting government intervention, where the government could take a piece of ownership in that company and will take their profits in the future then. So there's two stocks I want to highlight here from the airlines. Two of them give a nice contrast, one with a bit more debt than the other. So my choice between these two is Ryanair. So there's a lot of different reasons why I would pick Ryanair here, and it basically goes down to the amount of cash they have, their fleet and how much they own out of that, and then how efficient the business is as well. So firstly, the cash position. Ryanair will be able to last until December without having to take on any debt or without the government have to intervene. Whereas EasyJet, on the other hand, will only be able to last until August. So if they hit that August stage, they will have to take on more debt, or they'll have to get the government to come in and support them, which will eat into their profits. Ryanair being able to last up until December is a lot of cash to have on the balance sheet, and we should see the flights will be back up in the air before that stage. With the fleet then, Ryanair owns 77% of their fleet outright, whereas EasyJet on the other hand owns 70%, and they've actually sold off a lot of this now and leased it back from different people on the market. So with this, you would imagine the company will have to sell more of their fleet at a discount if they hit that August stage and they need to get more cash into their balance sheet. Looking next then at the load factor is the average amount of fill rate on each flight. So the load factor for Ryanair last year was 96%, whereas for EasyJet it was 91.5%, which shows how much more efficient Ryanair is. And with this then they'll be able to get more profits from that efficiency, so it really makes them look like a more favourable airline there compared to EasyJet. Next, looking at the average fare. So the average fare for EasyJet last year was £60, whereas for Ryanair it was €53. And like that point I mentioned, that if we do hit a recession, consumers are going to come back and want to fly, but they will want to fly at a cheaper rate because they will have less discretionary income. So they're going to vie for the cheaper option here, which will be Ryanair. Then if we're going to look at valuation metrics, the two best valuation metrics to look at are the price to earnings ratio and the price to book ratio. So the price to earnings ratio shows the price of that stock on the market relative to the earnings for the stock. So if you have a low price to earnings ratio, it may show that this stock is undervalued, and then the higher the price to earnings ratio, the more overvalued the stock is. So the price to earnings ratio for Ryanair is 10.86, whereas for EasyJet it's 7.26. So EasyJet is actually undervalued compared to Ryanair, but we would expect that based on the good cash position that Ryanair has, and then the other factors we talked about that makes Ryanair a more favourable selection there than EasyJet. Looking at the price to book then, the lower the price to book, the more undervalued the stock may be as well relative to its assets. So you have the price of the stock on the market and then the amount of assets per share for that stock then as well. So the price to book ratio for Ryanair is 1.77, whereas for EasyJet it's 0.86. So EasyJet is undervalued relative to its assets as well compared to Ryanair, but you do have to consider those factors like the government giving them a loan, and then the fact that they may intervene in the future and take a piece of ownership in EasyJet. So EasyJet took a loan from the government, and if they come in and intervene again, profits won't be paid out to shareholders as much as if the government didn't intervene. As well as that, then they will have increased debt repayments from this, and this will eat into the margins and eat into the profits for you as a shareholder in the business. And they took 2 loans for 400 million since coronavirus has started, which will have to be paid back as well. So that's pretty much it for my stock picks for 2020 and what stocks I would pick in the airline sector as well. Hey, thanks for watching. Subscribe to my channel now to stay up to date with the latest videos. See you soon.